Hi, welcome to VC Circles, the classroom show. I am Vijay from Wadia Ghandy and Company, and today I am going to talk about filing for IPO. What is an IPO? This is when an unlisted public company either makes fresh issue of securities or offers for sale the securities of its existing shareholders to the public for the first time. There are certain general conditions that SEBI has prescribed for doing an IPO. Companies wishing to do an IPO have to comply with certain eligibility criteria as prescribed in the ICBR, which are as follows. Net tangible assets of at least 3 crores in each of the 3 preceding years. Net worth of at least rupees 1 crore in each of the 3 preceding years. Track record of distributable profits in at least 3 out of the preceding 5 financial years. The proposed issue size, together with any other equity issuance that the company may have done in that financial year, should not exceed 5 times the pre-issue net worth of the company according to the previous balance sheet. And lastly, if the company has changed its name during the last 12 months, the company has to ensure that at least 50% of its revenue during the last 12 months has been earned by the activity indicated by the new name. Companies that fulfill the above eligibility criteria are entitled to a fixed price issue, where at least 50% of the proposed issue has to be reserved for small or retail investors. Companies that do not fulfill the eligibility criteria that we have just discussed can also do an IPO, subject to the condition that the issue is made through compulsory book building process or the appraisal route. What is the book building process? Book building is a process that helps determine price and demand. In this process, the period during which the IPO book is open, bids are invited from the public at various price levels, and the final price is determined on the basis of the bids received. The book building process requires that at least 50% of the proposed issue is offered to and subscribed to by qualified institutional buyers. 35% of the proposed issue is reserved for small retail investors, and the balance is available to the other investors. Whereas the appraisal route requires that at least 15% of the project cost is contributed by scheduled commercial banks or public financial institutions, out of which at least 10% is contributed by the appraisers, and the company has to undertake to allot at least 10% of the proposed issue to qualified institutional buyers. In addition to the above, the company has to ensure that the minimum post-issue face value share capital of the company is rupees 10 crores. SEBI stipulates that the minimum public shareholding of a company after the IPO should be at least 25% of the post-issued share capital. SEBI also stipulates that a minimum of 20% of the post-issued share capital of the company should be held by the promoters. Therefore, if promoters hold less than 20% shares at the time of going for an IPO, they have to make sure that they invest more money into the company before the IPO opens to ensure that they hold at least 20% of the post-issued share capital of the company. The minimum promoters' contribution of 20% shall be locked in for a period of 3 years after the IPO. Any share that they hold in excess of 20% shall be locked in for a period of 1 year after the IPO. Let us now discuss the broad steps involved in doing an IPO. The first step is appointment of merchant bankers. The issuer company is required to appoint 1 or more merchant bankers, out of which 1 merchant banker shall act as the lead merchant banker. The primary roles and responsibilities of merchant bankers include overall coordination, due diligence, assisting the legal counsels in drafting of the offer document, finalizing the disclosures to be made in the offer document, and interface and ensuring compliance protocol with SEBI and the stock exchanges. The merchant bankers also help the issuer company in appointing the other intermediaries, which are as follows. Legal counsels to the issue. The main role of legal counsels to the issue are conducting legal due diligence, drafting the offer document, and ensuring gentle compliance with the applicable laws. Underwriters to the issue. Role of an underwriter is to undertake to subscribe to the shares which have not been subscribed to by the public. Where the issuer is making a public issue other than through the book building process, appointment of underwriter is optional. The company may or may not appoint an underwriter. Whereas where the company is making an issue through the book building process, appointment is mandatory. In such a situation, the company has to enter into appropriate underwriting agreements. Appointment of registrar to the issue. The role of registrar to the issue is to coordinate with the issuer and the bankers for collections, reconciliations, refunds, securing allocation approval from the stock exchanges, processing application forms, and initiating the allotment procedure. Then the companies also appoint brokers to the issue for marketing the issue. Now all companies are compulsorily required to obtain a grading for IPO. For this, they have to appoint a credit rating agency registered with the SEBI. The companies normally also appoint other intermediaries, which include your depositories, printers, advertisers, escrow banks, collection banks, and self-certified syndicate banks for accepting ASBA bids. What are ASBA bids? ASBA is a process for making an application for shares. In this process, the monies are not debited from the account of the applicant upfront, but is merely blocked by the bank until allotment is made in their favor. What are ASBA bids? ASBA is a process for applying for shares in an IPO where the amount that the applicant is supposed to pay for those shares are not debited from their account upfront. The bank merely blocks those amounts, and when final allotment is made in the favor of the applicant, at that time the amount is debited from the bank account. Let us now discuss the next step involved in doing an IPO, which is drafting of the offer document. An offer document is the most crucial document for an IPO because this is the document on the basis of which public will be invited to invest into the company, and there are criminal liabilities on the directors for making any misstatements in the offer document. The offer document is drafted for giving as much information to the public about the company as possible. The lead merchant banker has to verify and certify the contents of the offer document and has to ensure that the company is not making any false claim in the offer document. Once the draft of the offer document is ready, the draft offer document has to be filed with the SEBI at least 30 days prior to filing the final offer document before the ROC. Once the offer document is filed with the SEBI, they make it available for public comments by posting it on their website. The lead merchant banker has to file a statement with SEBI informing them of the comments that have been received by the public, by company from the public, and the consequential changes that may have been made to the offer document. SEBI may also give comments on the offer document. So if any changes or observations have been made by SEBI on the offer document, the issuer company and the lead manager has to ensure that the offer documents are amended to take care of the comments received from SEBI. Once SEBI's comments have been taken on board and the offer document has been amended accordingly, the issuer company and the lead merchant bankers have to finalize the offer document and file physical copies of the final offer document with SEBI. The ROC of the place where the registered office of the company is situated, and the stock exchanges where the shares of the company are proposed to be listed, by paying the prescribed fees. The lead merchant banker is also required to file with SEBI along with the offer document the agreement that the lead merchant banker has entered into with the company, a statement of the inter-allocation of responsibilities between the merchant bankers, a due diligence certificate, and a certificate in the prescribed format certifying compliance with the regulations for drafting the offer document. Once the offer document has been filed with the authorities, it's time to market the issue. For marketing the issues, the companies normally hold roadshows which involves meetings and discussions with the merchant bankers, the brokers, and of course the prospective investors who are going to put their money into the company. Thereafter, the companies are required to print sufficient number of offer documents and application forms and distribute it amongst all the stock exchanges, the underwriters, merchant bankers, and the brokers, so that they can be widely distributed amongst the public. Then comes the time for statutory announcement. An abridged version of the offer document along with the issue open and close date are required to be published in an English newspaper having wide circulation, in one Hindi newspaper, and one newspaper of a regional language where the registered office of the company is situated. Then comes the time for opening of the issue. Issue may be opened within 12 months of receiving comments from SEBI or within 3 months of the expiry of the prescribed time within which SEBI is required to give comments, where SEBI has not given any comments. Issue may be kept open for at least 3 days but not more than 10 days. After the closure of the issue, the company is required to allot shares to the investors. According to the listing agreement, the allotment has to be made within 30 days of closing of the issue, and the company has to approach the concerned stock exchange for seeking approval of the basis of allotment. Where the issue has been done through the book building process, the allotment is required to be made within 15 days of closing of the issue instead of 30 days, failing which the company is required to pay interest to the investors. Once the basis of allotment has been finalized, the company is required to actually list the shares on the stock exchanges. According to the SEBI guidelines, the company is required to complete all formalities for listing of the shares on the stock exchange and start trading within 7 days of finalization of the basis of allotment. Once the basis of allotment has been finalized, the company is required to list the shares on stock exchanges. As per the SEBI guidelines, the companies are required to complete all formalities for trading on stock exchanges within 7 days of finalization of the basis of allotment. Once the issue has happened, the shares have been listed, there's certain other formalities that the company and the lead merchant bankers are required to comply with, which basically include filing of various forms, certificates and reports with SEBI, the concerned stock exchange and the registrar of companies where the registered office of the company is situated. That's all that I have for today. I hope you have enjoyed the lecture and have learned something out of it. If any of you are in the midst of or are proposing to do an IPO, then all the best to you. This is Vijay Sureka signing off. Have a good day.